Good morning and welcome to this Wednesday, May 19th, 2021 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, last night we had a pretty good session on Max Payne. Did show the S&P 500 in a position maybe to lose a couple percent. Didn't know it might be the next morning. But that's kind of the way things are setting up right now. Anyway, we got I'm being a little dramatic, but futures are down quite a bit. We've got the Dow Jones down 350 points, which is down about 1%. S&P 500 down 47, which is a little more than 1%. NASDAQ down 203 points. Futures looking to go down about a 1.5% at the open. But that's just part of the story. Cryptocurrency is absolutely getting crushed. Bitcoin down 20%, down to 34,000 from 43,000 yesterday. Ethereum, which has been on an absolute roll, down 37% today, down 1,200 from 3,300 and change up near 3,400. It's now down at 2,100. Huge drop in many of the cryptos overnight. Gold hanging in there. Gold is one of the few things I've seen that's actually unchanged or relatively unchanged from yesterday. Copper prices down 2.5% this morning. Silver down 1.8%. Crude oil down 1.9%. That is. Looked over in Europe, the German DAX down almost 300 points, 1.9%. So things definitely not off to a very good start today. We're going to get into a little bit of that in the seasonal weakness that we tend to see around this time of the month. We talk about it every month, but it's worth talking about because it does stand out historically, not just the last couple of months or the last couple of years. It's not like this is just a short-term kind of a thing. This historical weakness this time of the month has been going back many years, 70 years, 71 years to be exact on the S&P 500. So we'll go through some of these numbers that I think are pretty key. But let's go ahead and jump in first. Take a look at, if you are new to Earnings Beats, just want to take a look at the website just so you can get a quick idea of how you can maybe learn a little bit more about Earnings Beats. We do have a free Earnings Beats Digest newsletter. Comes into the into your inbox Monday, Wednesday, Fridays before the market opens. No credit card required. You can unsubscribe at any time. All you have to do is type in your name, email address, hit that subscribe button, and you'll be set. You'll learn about some of the things that we really like to feature and talk about at Earnings Beats: earnings, relative strength, many of the various industry groups. It's really all about leading stocks and leading industry groups. Now, unfortunately, today is draft day, and our last draft day wasn't so good. It wasn't good at all, to be honest. And, we had several quarters that we strung together that were incredibly solid, really almost unheard of. I think we managed to get through the pandemic pretty well. But last quarter, with the rotation from growth to value, that definitely hit us. And we try to be transparent with everything we do at Earnings Beats. It was not a good quarter for us. You can see on our homepage. We haven't shied away from the results. I mean, if you're going to post the good stuff, you got to post the bad stuff when it happens too. And the last quarter has been rough. And there are reasons for it. I mean, if you look at the IWF-IWD ratio, which is growth versus value, and if you look at a chart, you'll see that actually support broke down on February 22nd, the day after we announced our draft. So, it was unfortunate. I think the timing was really bad. But I am looking forward to our draft today to basically shed ourselves of the last quarter, all the stocks, and then go with what we believe are the best stocks to go with for the next 90 days. Hopefully, we don't have another complete reversal in the market where all the leading stocks get hit for 3 months. But, the market throws curveballs all the time. And it's really the end game. It's the long term that you need to be worried about. I mean, obviously, short term, you don't like to lose money, especially when the market's going up. I don't. I'm sure not too many people do. But it is the long term that we're trying to focus on with these portfolios. And if you look at the since inception results, even with the bad quarter, we're still ahead in every single portfolio and a few of them by quite a bit. So we'll lick our wounds from the last quarter, and at 5:30 this evening, we will be announcing the 10 equal weighted portfolio stocks. And to be a part of that, you do need to be a member at Earnings Beat. So we have a lot of sneak preview events that are public where you can kind of get a sense of what we do and how we look at the market and how we make our selections and the strategies and all of that. But if you actually want to be there for the draft, you need to be a member, and you can just be a trial member. So if you click this Join Today button, you'll get a 30-day, or you can get set up to have a 30-day trial at no cost. You'll pay $7 at the beginning, but we will refund you that within 7 days. It's just to get everything set up in our system. So essentially, you have a 30-day no-cost trial, and you can get the stocks that we're putting into each of our 4 portfolios. All right, let's move on to what happened yesterday, because honestly, it was not a good finish to the day. We're going into the tail end of options expiration. This is the time of the calendar month, starting on the 19th, where we tend to see weakness, and we did not get it off to a good start with the way we finished yesterday. The Dow Jones Industrial Average was down 267 points. We did manage to come down here and finish just below the 20-day moving average. Don't be surprised if we see another retest of where we were last week. Another move down there would test the 50-day moving average. I think we'll see that. The S&P 500 down 35 points yesterday. And with today's pre-market action, certainly looks like we're heading back for that 50-day test, probably to maybe at least retest the lows from last week. The NASDAQ could not get through its moving averages, got close. And this is what you typically see when you're downtrending. You move down, you test the 20, you move down again. You come back up, didn't quite test the 20, but we got close, reversed late in the day, and now we're down quite a bit this morning with futures, likely to go back down, test 13,000. I think the way this is setting up, we're probably going to test this 12.4, 12.5 area on the NASDAQ. It just looks to me like that is going to be the case. I guess we're going to find out here fairly soon. Mid caps, small caps also hit hard. Small caps finished at 1341, which was just below both the 20 and the 50-day moving average. So small caps, I'm sure, going to get off to a small, well, probably off to a little bit bigger loss, and likely well below both of its moving averages at the open today. So small caps will be worth watching as well. Looking at strength yesterday, the only 2 sectors to finish in positive territory: real estate and healthcare, 2 defensive areas. The areas that got hit the hardest: energy and industrials. Energy trying to get through that 55 level, put in a little short-term double top. Certainly appears like maybe we'll go back down to about that 52 level. Industrials finished almost right on the 20-day moving average, just 9 cents above it. With today's open, looks like we're going to be trading down below. So unless we get a recovery, I would expect more weakness. And looking at the negative divergence on the daily chart, higher prices, lower PPO, I would expect that 50-day test. So I think that's where we're probably heading. Just wanted to point out, renewable energy, after making a run for a few days, got close to its 20-day moving average and then kind of rolled over. Still finished with a gain yesterday of 1.9%, but that was off of its earlier high. And as you can see, that 20-day test has been pretty difficult for renewable energy stocks over the course of the past couple of months during this growth stock sell-off. So you got to pay attention to the moving averages until we can get back above. What we want to see in an uptrending market is price action above the 20, which is above the 50, and everything moving up from left to right across the chart. Right now with renewable energy, we have the exact opposite. Price action below the 20, below the 50, and everything moving down. That's a downtrend. All right, moving on. We got the 10-year Treasury yield. Nothing really out in terms of economic news this morning. So the market, this time of the month, we're focused much more on options and what the options are suggesting. One thing to keep in mind, though, is the NASDAQ. Actually, when we went through our calculation last night, the NASDAQ's max pain is above its current price as of yesterday's close. So today's gap down will be really interesting to see what market makers do here over the next couple of days. I would expect, if we're going to see a rebound, My expectation would be maybe it would be in the NASDAQ stocks off of today's gap down, but we'll see. See how things progress throughout the day. So I wanted to talk a little bit about the action in the market as we get into this time of the calendar month. If you're not familiar with earnings beats, if you haven't really listened to me either this year or over the years, because I've been talking about this for many years. The 19th of the calendar month, here are the annualized returns. The S&P 500 since 1950, the annualized return for the 19th of the calendar month is minus 33.66%. Now that includes, let me give you how many days that represents. That represents 594 trading days. Just that's how many 19ths there have been since 1950, 594. 253 trading days in a year. So if you just do a little simple math there, you'll see that about 2.4 years is, that those 594 days represents about 2.4 years. So just imagine, some of our worst years have been in that 30, 35% down area. So just imagine having almost 2.5 of the worst years we've ever had just consecutively every day for 2.5 years. That's what the 19th of the month represents. It doesn't go down every day. Of the 594 days, 281 have been higher. 313 have been lower. So 47% of the days go higher and 53% go lower. And that compares to throughout the year, 53% of the days going higher versus 47 going lower. So statistically, I think it's relevant. The odds are definitely greater. There's something going on with this time of the month, and I believe it's options. But you just have to be aware. And so when I wake up on the 19th of the calendar month and I see futures on the Dow down 350, I kind of yawn. It's, I don't expect that much. That's certainly not the average, but I'm not really surprised because history tells me that we've got to be ready and prepared for selling as we move toward options expiration. That's just what the market tends to do. And I want to emphasize tends. It could be up a week from now. This next week, which tends to be very bearish, sometimes it goes up. It doesn't always go down, but the tendency is there. And when you're trading, honestly, it's all about probabilities. You'll never have any guarantees. It's about probabilities. So the 19th of the month on the S&P 500, annualized returns minus 33.66%. On the NASDAQ 100, I did this based on the, actually, no, it is the NASDAQ. I was thinking it was the QQQ, but it's the NASDAQ. So on the NASDAQ, the 19th produces annualized returns of minus 30.36% since 1971. And you follow that up with the 20th, which on the NASDAQ is actually slightly worse, minus 31.7%. So on the NASDAQ, the 20th is the worst day. On the S&P 500, the 19th is the worst day. But back to back, the NASDAQ, 19th and 20th, those are horrible days. The S&P 500 on the 20th goes down. The annualized return is minus 8.52%. So it's also weak. By the way, the next worst day of the calendar month is the 9th. I always talk about that profit-taking period. Historically, from the 7th to the 10th, the market tends to do really well to open the month through the first week. And then you go through a profit-taking period, 7th to the 10th. Well, the 9th has an annualized return on the S&P 500 of minus 18.21% over the last 71 years. And the NASDAQ annualized return on the 9th, minus 17.12%. So again, those are days that you just need to at least be aware of. And I know it probably seems very random to some of you who don't follow the market, but if you understand how the market works, it makes a little bit more sense. because the beginning of the month, you've got money coming in. I was in public accounting for many years, 20 years, and I audited companies. I did payroll, and people, most companies have payroll that falls like on the 1st and the 15th or at the end of the month. And what they do is they gather everyone's payroll withholdings, and you turn around, you send it off to the Vanguards or the Charles Schwabs of the world, and that money gets invested however the employees direct it to be invested. So this money, many companies are sending money in the beginning of the month, 1st of the month, 2nd of the month. And so money drives the stock market higher in the first 6 days of the month. The last 4 days of the month are strong because the professionals know that money's coming in. So you got portfolio managers that are buying, market makers are buying before the money comes in. It's almost like legalized front running. That's what I call it. You know the money's coming in and going to be buying stocks that you're going to be getting into. So you buy at the end of the month. And it's not, let me read you some numbers. Here are the numbers on the S&P 500 for the end of the calendar month. Now, keep in mind, the S&P has gone up an average of 9% a year. We're going to get to all the charts right now. I just have this sector summary showing for you on your screen. So just bear with me here for a couple minutes. The 28th of the month, the S&P 500 has an annualized return of 20%. And again, that compares to 9% throughout the year. I mean, average year for the S&P is 9%. So you would expect, if all days were created equal, that all 31 days would have annualized returns right around 9%. I mean, after all, we've been doing this a long time, 71 years. We should average out pretty close to that 9%. That's not the way the market works, though. 28th, 20%, 29th, 20%, 30th, 15%, 31st, 27%, 1st, 46%, best day of the year or best day of the calendar month, 46%, the 2nd, 38%, the 3rd, 22%, the 4th, 5%, the 5th, 30%, the 6th, 19%. That 28th to 6th period, every day but the 4th is well ahead of that 9%. And it's because money comes in anticipation of the actual money coming in from all of people like you and me through our 401ks and so forth. So you got to know as a trader how the market tends to work. Then you go into the 7th through 10th period, the S&P down 10%, up 4%, down 18%, and up 7%. All 4 of those days below that 9% threshold. And then again, you move into the 19th to the 25th period, which I think it struggles because of options expiration. So 19th down 33%, 20th down 8%, 21st up 3%, 22nd down 10%, 23rd down 5%, 24th flat, 25th down 6%. All of those below that 9% threshold, every single one of those days, 7 days in a row. Anyway, I just want to point that out. Why? Because it's the 19th of the month. We see the futures down. Don't be shocked. And if you wanted to take, precautions in future months, maybe build up some cash, maybe even do a S&P put. If you trade options to protect yourself, little insurance, it's probably not a bad idea. But anyway, just want our members to be aware of it. Okay, let's move on here. So what I did, why I pulled up the sector summary, when you go into options expiration, you've got to pay attention to the areas that have been leading the market. So I pulled up a 1-month sector chart just to show you that over the last month, where you're going to see most of the strength is in energy, materials, and financials. Okay, energy, materials, and financials. And when we went back here, you could see energy was the worst performer yesterday, down 2.3%. Financials didn't have a very good day either, although they weren't among the top 2. But industrials were there, and you can see industrials at least in the top half. I talked about renewable energy doing fairly well yesterday. Well, that's part of technology. Technology's been hit the hardest or among the hardest over the past month. So that's a group that probably is going to be beaten down where more options, put options have been played, where maybe some of those companies, it might make sense to see a little strength into option expiration day. I've written articles, I've talked about this plenty of times in the past, where, we get to Friday or we get to the following week and we look and we see how, which areas of the market have been so weak. And then you look at their scooters, and that's just stock charts technical rank, just to give us an idea of what, relative strength, which has been leading, which hasn't. 100's your highest score, 0's your lowest score. So you kind of get ranked. But you can see scooters, if I pull up a 1 day, just yesterday, you'll see that down at the bottom, look at what's down at the bottom yesterday. Materials, financial, industrial, and energy. The 4 best scooter scores. I mean, don't be surprised if some of these areas have rough weeks. Why? There's a lot of in the money calls. Whenever the groups are really strong, traders get excited. The options world, there's a lot of great options traders out there, but the masses simply follow the crowd. They see the market going higher. They see materials going up day after day, financials, banks, all going up. So they jump in on options, not realizing that it's like, walking, out in the mountains and stepping into a rattlesnake pit or a nest or whatever it's called. That's kind of the equivalent. You got to be careful with options, especially heading into option expiration week. Be careful with the groups that have been leading. Those are the ones that are likely to have the most in the money call premium. That could be, it's almost like a carrot, for market makers. It's like, here, come and get some money. And they like doing that. So anyway, just be careful. So that's why I wanted to show it. And you can see right now the S&P 500, I think the negative divergence here probably is going to continue to weigh on the market. Let's get through to the 25th. I think the 19th to the 25th could be a period where we continue to stumble a little bit. We had this breakout. We could see the S&P on this move down go below 4,000. I would not be surprised. Don't be shocked, especially if technology doesn't recover. If technology doesn't head back up, other areas of the S&P look like they're vulnerable here. So we could clearly go back down to that 39.75 area just to test this breakout level. All right, moving on. Let's take a look at the Fang stocks for a couple of minutes here. Facebook gapped up, pulled back. You can see pretty clear price support level just below 300. The 50 days now at 300. So Facebook weakens down around that 300 level. That's about the area where I would expect to see a little bit more strength, or at least some consolidation take place there. Amazon, it seems like, years ago, but Amazon tested the September high back at the end of April, above 3,500, went all the way back down almost 3,100, bounced a couple hundred points, and then don't like that candle yesterday at all. And that's another thing to watch going into the 19th. When you start to see, reversing candles at major resistance areas, and you've got the 19th and options expiration facing you, I think you've got to be really careful. But Amazon looks to me like it probably setting up perhaps to go back down at least to that 3,100 area. Apple, Apple's just been going sideways for a while. It's actually been fairly consistent. I mean, we've had, the big drop there. We started gaining ground, but really, when you see all of this movement below the moving averages and above the moving averages, just continuously throughout this entire 7-8 month period, it's telling me there's no trend. Apple is not trending. So don't try to buy it on a test of the moving average or sell it on a test of the moving average, because it's not trending. You're going to get whipsawed probably if you're playing moving averages with Apple. So I just don't see much of anything going on right now with Apple. Not bullish, not bearish, really. Netflix, I think also sideways for a long time. These lows right in here, 460 to 470, watch those as we head into options expiration. My guess is Netflix, if it gets down in that 460, 470 area, probably is going to be set up pretty nicely for a bounce. Google's been a pretty strong stock, one of the better internet stocks. It clearly remains in an uptrend. So many times it'll pull back, hit that 20-day and hold. just like there. But over time, we're going to eventually get the 50-day test, which is what you can see multiple times as well. Already a few 50-day tests here in 2021, but that too had a reversing candle at the 20-day. I would expect at least to move back down to test that 2200 level. And honestly, we could go back down and hit this breakout area around 21.25. That might be a more reasonable move here since we are heading into the bearish period. One other one, I know it's not part of Fang, but I still think it's worth looking at, Microsoft. Microsoft right now, I think you've got to at least pay attention to that 20-day moving average because you can see a number of failures there already. So I expect we're going to roll over and fail to hold this low. And I could see 225 to 230 in Microsoft's future. And that's going to be a pretty big support level because we had multiple highs in that area on the way up. We've already bounced off that area on the way down. And if you believe that we're in this uptrend, higher high, higher low, higher high, you can't go below this low to have that uptrend in play. So that 225 area, I think, will become very important if Microsoft continues to sell off. All right, earnings. And this will be one of the keys when I go through the draft later. You know, we want to see companies that are beating earnings estimates. 3 of the 4 portfolios are based on companies coming from our strong earnings chart list. The only one that doesn't, that could be comprised of stocks that don't beat earnings estimates is the strong AD portfolio. And that's been our worst performer this quarter. I mean, we've had 3 pretty bad ones, but that's been the worst. And so still, continuing to research that. I mean, we had 2 great quarters with the strong AD, but one very weak one. So we'll see, try and take a look at those, not only the strong AD, but try to make sure, or at least hope that we're in the right groups. Because again, most of those growth stocks did not pan out the last quarter. All right, looking at the earnings. So yesterday, I want to show you how the market reacted yesterday. These companies that I'm going to show you all beat earnings yesterday. So here's Walmart, gapped up, failed. Home Depot, gapped down a little bit and then continued to move lower. NetEase, gaps up. This was probably the best performer of all of them, the best reaction, because it stayed near the high at the end of the day, which has been unusual for many of the stocks this earnings season, especially anything within the aggressive areas. Baidu. So Baidu gaps up to its 20-day, fails. Then we got TCOM, which is ctrip.com. It moved up for the day, but you can see it actually finished almost right on the low of the day. So even though it did move up, and I'm wondering if this one actually reported before or after the close. Let me see if we're getting a reaction here. I'm not sure when they reported after the close yesterday. Okay. So I guess today will be their reaction. Not much of a reaction here. But my point is that most of these stocks, and we're especially seeing it in technology, consumer discretionary, these stocks, even if they have good reports and they gap up, they really struggle to go any higher. And that's telling me, if we're not getting breakouts with earnings, it's telling me that we're probably fully priced and that we're going to continue to consolidate, maybe even move a little bit lower. So let's take a look at 3 companies for our 3 you must see. Here are 3 companies that have reported earnings today. The first one I'm going to show you is, and I'm going to pull up the actual reaction here. First one is Lowe's. So Lowe's company's down 2%. Now you can see, I could almost guarantee that was a negative divergence right there. Moved up, pulled back, hit the 20, bounced, went to a new high. PPO, I'm sure, was lower. Let's just pull it up and just verify. Yep, there it is. Higher prices, PPO is lower. So there's your negative divergence. We went down, we tested the 50. I think Lowe's is a buy if it gets down to 180. That's where we broke out from. So it's down a couple percent today. So it's what, maybe $4 or $5. It's going to be down at the open. That's going to take us into the 180s. I think if it gets down near 180, and this is another one that could be hit a little bit with options. I don't know what the options look like, but probably a week ago when we were up at 215, and at an all-time high. Lowe's has probably had a bunch of options in the money. So I think if it pulls back a little bit further, that one would be very interesting. Target similar. Target is actually up 2.6%, but if it doesn't break out, I'd be surprised to see it break out today. I think if it gaps up and it can't get above 215, if it opens 210, 211, something like that, it might work its way to 215 intraday, but I think it'll probably close lower today. Just a guess, just based on what I'm seeing throughout most of earnings season. But I think there's a chance we go back down on target to about 198 to 200. Wouldn't be surprised. And then the last one I'll give you, and these earnings, by the way, Lowe's 321 versus 258. Target 369 versus 226. Now, everybody writing about the PE ratios being way high and all. I want to see what their calculations are after this earnings season is complete, because these stocks are blowing away earnings. I mean, earnings aren't even close. And over time, earnings do matter. Short term, there's a lot of short-term inefficiencies in the market. Long term, these earnings that we're seeing will matter. Got to, do the normal thing the market does, though, which is move up, pull back, consolidate, find something to, really talk about for a couple months to scare the heck out of everybody. Right now, that's going to be inflation and higher interest rates. Get used to it. That's not going away anytime soon. But anyway, I'm going to stop my rant there. So the last one I'll show you is TJX. So TJX reported 44 cents versus 31 cents. They're down 1% after, actually just opened. So you can see down 1.75% here. So probably heading back down to the recent low, maybe the 50-day moving average, but not because the earnings weren't strong. Earnings were very solid. We had broken out. Market was anticipating good numbers. We got them, and now we're getting a sell on the news. But anyway, that's it. So those are your three you must see. Want to just mention to, especially to earnings beats members, there will be no daily market report next 2 days. So I'm going to be out for 2 days. I don't take too many days off, but I'm going to take a couple of days, get through this draft tonight, and then unwind for a couple of days, have a long weekend, got family in town, that sort of thing. But I just want to let members know I've been writing up and telling everyone in the daily market report that there won't be one the next 2 days. I just want to remind everyone. And if you're not an Earnings Beats members, I invite you to join us. Again, it's a no cost trial for 30 days. Come in, check out the stock picks, really take a look at all of our research, our entire research platform, which I think is really top notch. And if you're a Stock Charts member, you can download many chart lists, probably a dozen or more chart lists that we have. If you're an extra or pro member at Stock Charts, you can download those right into your account. It's so easy, takes seconds, and all of our research is literally in your hands. All right, that's it for me. Let's get one quick look, see what the market's doing, how bad it is. Here on the 19th again, feel like I'm on repeat. NASDAQ down 195, Dow down 400, S&P down 52. Look at the VIX back up to 25. VIX might work its way up to 30 or so before settling down. We'll see how that goes. But overall, pretty rough start. But again, it is the 19th and it is option expiration week. All right, everybody have a great day. I will be back tomorrow at Stock Charts TV for your next episode of Trading Places Live. It's our recorded version. Good news, though, we might be going live with that show in the near future, maybe within the next month or so. So I'm pretty excited about that. But for now, it does continue to be a recording, but you can get that at Stock Charts TV at 9 a.m. Eastern tomorrow over at stockcharts.com. Everybody have a great day, and I'll see you all next week in terms of the daily market report after today. But hopefully see you all at the draft later this afternoon. Take care, everybody. Happy trading.